first of all, thank you for everyone for joining the second of this regular series on the NSME Connect, soon to be renewed.net channel. It's really nice to see all my friends here. The format today is to focus a little bit on an interview with some of our best friends on the topic of what's happening to budgeting and what we're looking forward to 2021, which is, maybe perhaps the most important question business-wise. So good to have you all here. And I'd remind you that one of the great things about this the new channel is, of course, all of us are on it. So whatever doesn't get answered in this supposedly 45 minutes, and we'll try to keep it to that. We may stretch a little, though one of the speakers has to introduce an event, so there's a hard stop there. But the nice thing is we're all on the channel, so if you've got questions, you can reach out one-to-one, or you can reach out to anyone you want on the channels within the Slack channels. So it's very easy to continue the discussion if you need more information. So the main purpose of this is to get us all together, hear what we're all thinking, and open up a conversation that'll continue as we go through the planning cycle. I also just want to remind everyone that we've got an incredible amount of programming. We're adding an editorial and content roundtable starting October 6th at 11 o'clock. So get your people with a strong interest in the content bent onto that one. We're doing a sort of creativity and leadership and, wellness and emotional intelligence workshop, I think October 13th, though that date may move around a little bit. And we're also working on a diversity and inclusion webinar, since that's obviously even more critical now than it's always been. We've got some incredible experts who are coming in on that. That'll be the week of the 26th. And we've got the regular events roundtable and the regular marketing and sales roundtable. And who knows what else we'll add in the next month. I'm personally suggesting that we have morning yoga classes, yoga aligned with the information industry, which is a special it has kind of a dance perspective, I think. So, keep those all in mind. Thank you for being part of this new community. And I'll kick off now with the topic, which is 2021. What are we thinking in this period of uncertainty? I don't think we have to spend a lot of time trying to guess what's going to happen, because while I think some of the people on this call can probably make better guesses than what I'm reading in the financial press, we just don't know. So I think we have to plan wisely and aggressively. So I'll start out by asking, and maybe Dan, if you don't mind, I'll start with you because of your involvement on the Slack channels and everything else. Given all the changes we've gone through and all the things we've learned in the last 6 months together, where are you placing your bets on 2021? What are you hoping?
Yeah, so 2020 is not over yet, but it's been a bit of a crazy year, and it's really pretty hard to forecast in this type of environment for next year. That said, for Money Media, it's our business hasn't been turned upside down. The vast majority of our revenue comes from digital subscriptions, and that area of our business has been strong. We have an advertising business and we have an events business, which saw more volatility. But there's been a lot of stuff figured out in those areas also. In terms of what we are investing in for next year, I think from a financial perspective, we're investing in content and technology that drive audience engagement. It's for a subscription business, those fundamental investments in making sure that we have great content and new areas of great content and also the technology that delivers it, and makes sure we're engaging our audiences with that content. That's just the fundamental sort of playbook for us, is to make sure we're producing the best content in our areas, and making sure we're getting it out in a way that's engaging the audience. The way we talk about it internally is, we produce great content, we generate engagement with that content, and then we monetize the engagement.
Are there specific areas, Dan, in does that mean maybe hiring more content development staff, or making adjustments there, or investing in particular types of technology as you look forward? Do you have any sense of that?
Sure, I can give you some examples. On the content side, we are seeing enormous engagement with data visualizations. And we have reporters who have done work in this area, but we've hired, and we're going to hire more for next year, at least one, if not two, data visualization reporters. And these are people with special skills to manipulate data, to crunch data, as well as to write certain bits of code to display the data in unique ways. But they're not technologists; they're journalists. They're reporters, they're journalists that have these additional skills and can really create data visualizations. And the engagement is off the charts when we publish those. From a technology perspective, the technology to display those, and some of the ones that we haven't been able to display, to make the technology more flexible to display more types of data and interactive data, where the users can come in and they can click, they can move the mouse and interact with the data. From a technology perspective, one of the things that has been a problem for a long time, for ages, is that there's a lot of great content that some people would read and engage with, but they just never see it. And so we're really focusing on our technology to surface the right content to the right people. You can call it recommendation engines. You can call it a lot of different things, algorithms. But I'll give you a couple of tangible examples. We're trying to bring to the forefront for a reader when they're on our site, here's the most read story on the site that you haven't read yet. So maybe they read the top one and the top two stories, but they didn't read number 3. Okay, this is the third most popular story on the site, but you haven't read it. Here's the most popular one you haven't read individually. And that's a personalized recommendation that they will encounter on the site. We haven't got it all done yet, but we're investing in that technology. And other things like that. People, if we know a person's in marketing, here's the most read article by marketers on our site that you haven't read yet. Those types of things.
Yep. Well, there was an AMP group within SIA session yesterday on the technology behind what they're calling content hubs, along the lines of what you're saying. So I'm definitely hearing that theme from other conversations I've had, that investing in the technology to surface the right content at the right time. That's great. Cindy, can I jump to you next, just on where you're placing, where you're gambling or placing your bets, or however you want to describe it at WCG?
Sure. I think the biggest thing for us are our virtual events. We're investing pretty heavily in technology to deliver the events, technology for registration. And we're in a little bit of a different situation because we are marketing things under multiple brands. And so we need to be able to sort of communicate with our customers across quite a few brands. So that's changing our registration and our fulfillment of the events. We're also investing in people, production people for these virtual events. We've got one event that we're running this fall that's already got about 800 attendees. And you can imagine, as they all come in, we have to assign them with concierge. We call them, event concierges, and they come in and we try to help them get to where they need to be. That particular audience is not perhaps as tech savvy as we would hope. And so we have learned that we need very many more people to help our attendees get where they need to be. And that's been an interesting experience for us. And also we're spending some time investing in things for sponsors. The virtual, trade show floors don't really seem to be engaging our people, our attendees. And we're trying to come up with new and creative ways to get, to give our sponsors access and engagement with the folks attending. And when you've got 700 or 800 people, you know, we'll end up with probably 1,500 people at that conference. We have to find new ways of making that engagement happen. So that's where we're spending our money. And a little bit like Dan, we're investing also in content, in hiring more experienced reporters with deeper knowledge in clinical trials, which is really now our main focus. And as you probably all know, sadly, the world is getting more knowledgeable about clinical trials in general because of COVID. And we're really trying to communicate with consumers as well as the professional market. And so we're doing some of that for free because we feel like it's our obligation to educate the world on what's really happening with vaccines and therapeutics, and then obviously engaging with the professionals at a higher level. And again, to Dan's point, we're also investing in data. We started something called a knowledge base. We have an internal database, and we started a weekly email. And all it is 3 tiny bits of data. It's a 1 paragraph of content and 1 chart or graph. And we're focusing right now on COVID how it relates to trials. But the engagement has been amazing. And we're getting, you know, great traction, great opens. And so we've invested quite a bit of money in that to make sure that the content is, you know, right on point, you know, right on spot on for our leadership.
So it sounds like in order to do this, you're going to have to, both similar to what Dan said, you're going to need some more skilled people who have content creation, but also sort of, I mean, use the word concierge, but can also, I'm going to say, handhold it to connect it with your customers. Is that
for the events? Yes. I mean, that's where the concierge come into play. You know, we have people who greet them essentially as they enter the virtual event and help them find their way to the right session that they need to be at. And so we learned from our first big virtual event. The smaller events are easier, you know, under 100 are easier to manage. But as you go up into the over 1,000 and with a different audience that's not as savvy, we really need those concierge. And we also are spending just on the data point, and I'm sort of in a lucky position because, you know, we are owned by a clinical trial expert company. I have these amazing SMEs at my disposal, you know, to help me figure out what those data points need to be, how people want to consume them, and then we have a great technology team that helps me present them in an interesting way. So, you know, technology seems to be the overriding factor here. I think that's really where we're putting most of our money, with some, you know, content investment as well on reporters and people to do that work for us. And you know, the humans that have to run these video productions. We've actually hired a television quality production crew that is actually running a lot of our big virtual events. And so they're fabulous, and we're using them more and more because the experience for the attendee is terrific. So that's something that's not cheap, but we believe it's the right thing to do right now.
No, how do you anticipate monetizing? Because you know, typically a TV crew coming in, that's another, you know, $50,000, $100,000, and these the concierge platforms. I think there are many of those companies, but I think they all figured out they're in demand, and it suddenly seems that there's a little price gouging going on. Those are the ones we've looked at are more expensive than our Salesforce implementation. Are you running into that problem too?
For the concierge, we're kind of managing that with freelancers at the moment. So we're not using an outside company. It's a little more labor intensive on our side, but we're managing to keep the cost down a bit. But on the production crews, you're right. I mean, it's costing us between $50,000 and $100,000 to get those crews up and running. And we're monetizing it in a mix of ways. Obviously, attendee fees, sponsorship, and then we're taking some of the content that we're doing, especially around patient advocacy, which is one of our kind of big topics. How do you get patients into clinical trials and doing all of that work? And then we're getting pharma company support and sponsorship on the back end to help bring that forward to the communities.
Yep. Can I jump to Wayne? Just some similarities with what Cindy and Dan are betting on. Are you seeing similar experiences on what's working?
Yes, I mean we're pretty diversified. We actually still publish print magazines for both the CEO and board communities, and surprisingly, those are actually doing quite well during this era of digitizations. Surprisingly, but those are holding up, and we're doing a lot more with our digital media, like our e-newsletters and websites as well, which are growing. So we're adding more newsletters and segmenting the market and working with our sponsors on those.
And what does that look like? Is that like going from 4 to 8, or what? How are you?
Yeah, so we had 3 newsletters, and we're doubling. We're doubling by the end.
That was a good guess on my part.
Yeah, so we had a weekly newsletter for CEOs, and one for board members, and a weekly for manufacturing CEOs, a segment. Yeah. Now we're kind of segmenting the market even more. We're doing one for tech CEOs, and we're working on one for financial services CEOs. And we're going to be starting to do it by ownership type, like PE CEOs. So that's one area that we're doing that hadn't been mentioned. But I'd say the biggest pivot is on our events. So 40% of our revenue, what did come from conferences, that was in our budget this year, was around the same. And they were very profitable, especially our bigger conferences that we do. So we've pivoted there, and I think that, as have you, many of you. But I think two things that we're doing a little differently. We've created some new models that we didn't do before. We used to do a lot of, we didn't do any huge 1,500 people conferences. We do it for CEOs, board members, but we'd have like 300 to 500 board members, our annual boardroom summit. We would we would charge $2,500 for an attendee, and we kind of had a nice mix. Half of the revenue came from attendees, half came from sponsors. And so what we found is in the online world, it's hard to keep the pricing up at that level. Nobody will pay $2,500 to be on a Zoom meeting for 2 days or 3 days. So we've dramatically cut our pricing there, and really relying on the sponsor revenue as the main driver on those. What we found is that it's actually more profitable. Without the hotel AV costs and the room commitments and all the food and beverage. So even with a 30% less revenue, those can be more profitable, those bigger events. Yeah. And then what we've also experimented with and had some success, for some of our events that are not sponsored, we dramatically cut the price and increase the number of people that come to them. So we used to do webinars, but now we do these paid mini conferences, half-day conferences that will charge $195 or $295 for, that we never did before. Because it used to be so much marketing and brochures. The cost of getting somebody in was high, so we priced them high. And now we're doing just with email marketing, we're pricing them low, and we're getting like a big keynote speaker. And we're getting 2,000-3,000 attendees for some of these events. So we did like an event right at the darkest hour in May, after we had just had to cancel a public company boardroom summit that was supposed to be at the Grand Hyatt in New York with 500 public company board members who are all in their 70s, and
great.
We had a refund of $500,000 in attendee revenue, which we also learned. Don't offer the refund, offer credit first, which was an expensive lesson we learned there. But we got like Jim Collins, Pat Lencioni, General Mattis. We're getting incredible people that we would never, in the past, we would get like one of them at a conference, but we'd had to pay them like $75,000 to $150,000 to fly in and do an event and pay for their private jets if they were big enough. And now we can, for $25,000, we can get anybody. And if they're really big, we say, we'll just give $25,000 to a charity of your choice. Yeah. And like we got General Mattis, who turned us down for $100,000 to speak at our CEO Leadership Summit. He was too busy. But when we said, we need 1 hour of your time. We'll give $25,000 to any charity of your choice. He was like, we'll work around your schedule. He found an hour, and we had 3,500 CEOs sign up for that. So that's a kind of a new model within online events that we're excited about. So
Yeah.
as you can imagine, we're doing a lot more of those now.
Yeah. All three of you have commented on successes in the building on the successes from the pivot on events. So we've got I asked Elizabeth Petersen and Jen Schwartz to join in, who are very dependent on events.
Yeah.
So Elizabeth, do you hear anything that triggers any new thinking based on your struggles along the same lines as Wayne, Cindy, and Dan?
Yeah, I mean, it's been, and I have a few of my event leads on the phone too, so it's been interesting. And I think that what we're exploring, sort of to Wayne's point too, we saw something pretty interesting. Our paid webinars started to go down because there's a lot of competition with free, what we think of traditional webinars. And so what are ways that we can replace it? And these virtual seminars or conferences, however you want to position them, are a good way to drive additional value. The costs are so low that you can take some risks with them. Also kind of drawing from Tom Gale's experience, we're thinking of a number of different things about how we package these virtual events, because we can get creative. And so things like a subscription program where you have an anchor virtual conference, and then perhaps a monthly webinar or networking session, and then using the conference app that we had for our in-person conferences, which, by the way, if you have those can make a really valuable tool and inexpensive if you're already contracted for virtuals, and creating a community that way. The other thing we're talking a lot about with this pivot is how do we drive value for these virtual events? And so we're looking to launch more certificate programs that come with these events. So you attend a certain number of days, you take an online exam, and you get certified in something. So, but that's what we're looking at.
Jen, are you hearing anything? Are you taking different approaches than what you've heard from?
Yeah, actually a lot of the same approaches. We're obviously highly focused on events. So we have a lot of our revenue, more than 50%, coming from events for our company. So we've successfully pivoted a lot of them to virtual, like over the summer. In fact, there's 3 this week that are all concurrent. I have our help desk up on my other monitor for one of my events right now. Kind of going along with what Cindy said, it's all hands on deck. Way harder to do. Lots of ops people needed, lots of digital people needed, making sure you've got your IT folks with whatever platform you're using, that they're plugged in. Because people do expect, if it's virtual, it's going to be quick responses. So, but yeah, I mean, I would say I'm seeing roughly a third to 40% of my revenues coming in on virtual versus a live event. So it's not optimal. I'd love to have more, but and it's really kind of mixed. Like I have some events where people are like, I'm not coming back unless it's in person next year. And I've had other events where we've got very high NPS scores and folks are like, this is awesome. Thank you for doing it. Totally agree with Cindy. The exhibitors has been the biggest challenge for us. We have been able to give them some metrics as to who's coming in, and we've tried to do some networking roundtables using some technology where folks can, especially after a speaker finishes speaking, they can go and connect with folks, at a roundtable, internally. So that's helped. Also, I think Wayne had mentioned like his advertising is doing well. Our digital advertising in a few of our markets, we're getting some big lift from companies that used to be in a live event, and now all of a sudden their budgets have freed up because either A, they're not switching to virtual, or they have some other immediate needs. So we're seeing some nice chunky revenue coming from digital advertising, some paid webinars. And then, as Elizabeth mentioned, we're also just starting to look into the membership program. We have a couple of our products that are already doing that, where they're rolling in a subscription with the events package. So it's like you pay a monthly fee for next year and you get everything. And whether It's a hybrid event, which I think a lot of our events next year in the second half of the year will probably be hybrid. I'm guessing the first half will be virtual, depending on a vaccine. But you pay a price each month, and then that gets you access to everything we offer. And I think we've got Lori Hoffman, who's one of our subscription marketers, on the phone. But I think Heather, you also joined, so I don't know if you wanted to add anything else, but that's kind of what we're seeing.
Well, jump in, any of you, if you want to, but I'll maybe just bring it back to Dan, Cindy, and Wayne. There's definitely some commonality, which I hope everyone on the call here is hearing. I'd say I just noted BVR, where we don't have the same size training programs or events programs that all of you do. We are expanding the training component in a bunch of different ways, but we're also, investing more in sort of paid, what I call paid lead gen, ancillary content products around the edges that capture new customers that we can feed into the sales channel, both in our prime market and our secondary market, because we're seeing the same trend outside of the events area that you're all seeing in the events area, that sort of new people are starting to show up in this virtual world. So we're trying to capture them with alternative blocks of content. So we're investing a little more in content creation. And we're also continuing to spend on technology, but more in support of sort of subsets of our data. So alternative, again, the same model as the events, but in the data area. So, and we've kept the cost, we've now actually have, we're a small company, but we have BVR India. We've got salaried employees in India at what remains an obscenely low compensation number that, let's not get into the social value question, but everyone in India is driving around in BMW, so they appear to be doing okay as far as I could tell. But that's allowed us to keep doing some pretty intensive programming around our data sets that are kind of in new technology. But to go back, maybe I'll go in reverse. Wayne, I'll start with you. What's your confidence level that these adjustments, you've taken the pivot, you've made the adjustment, that you're going to get, are you anticipating holding steady for 2021? Or do you have to patch other parts of the business where you're losing ground? When you look at the big picture, where do you think you can get to?
Yeah, so certainly there's a hole on the live event side, where when you convert those live ones to online, we're making up about half of that. So, but it was 40% of revenue. So now you start with 20% there.
You got a 20% hole. Yeah.
So there's a 20% hole. So we're kind of pedaling harder as a team and innovating. This year we would have done 12 live events that will all be online. Next year we're planning to do 22 that we already have slated. Yeah. But we're pedaling harder to stay where we are. But with that net, we hope to do, we expect to grow. But to your line, and we're making a few other bets in terms of investment too. We're also investing in our database research team and the products there as well. So we're doing a lot of new product development. I think the one thing that we have found that, like on the event side, is that a break even, an event that used to do $150,000 a live event was kind of a break even. 100 to 150,000 was a break even. It wasn't worth doing. We wouldn't repeat that event. But in the online world, if it's a $75,000 half day event and our costs are $25K, that's a pretty nice thing. We just have to do a lot of them. So we're doing a lot of it. That's where the mix is changing. So we've been adding a few, not many, but we've moved a few people around, and we have a small but mighty events team that's with web capabilities and logistics, etc. It was 3 people. We're adding 2 more to that team to support the additional volume, and they're but we did 2 live events last week. We have an event going on right now with 300 CEOs, our CEO Talent Summit that's going on right now.
Yeah. Yep.
So this mighty team, they're doing great work and working really hard. So, we are worried about burnout. So we're like making sure, like, August, we made everybody take off some time because we knew we had no events going on in August, and September was going to be great. The rest of the year is pretty crazy till Thanksgiving. But then we're going to close early at Christmas time. We're going to close for the week, give everybody an extra week vacation as long as we hit basic metrics. So we're trying to do some things like that.
How would you rate your confidence? Because I think this is true. It's a question for all of you, but Wayne, since you brought it up, we're 6 months in from when we all went remote. I think it was last week or whatever. Somewhere around there. We've had to change immensely. How would you rate? You're the CEO, you're in a planning process right now, and you're sort of looking at what resources you have available.
Right.
And one of them is your leadership team, which may or may not be exhausted.
Right.
How would you rate your confidence compared to a year ago as you look at the assets you have that you can deploy to try to grow?
So, I'd say just from a budgeting process, we used to have one number, one revenue target, and one profit target. And I think we did during the crisis, we kind of, for the rest of the year, some of us were more optimistic, hopeful. Like I was like, oh, we're gonna have a vaccine by the end of the year. Things will be better. Some of my team were much more pessimistic. And so what we decided to do is we have a conservative budget and then we have a target. And so we kind of rebuilt our cost structure around the conservative budget, and assuming, so that we can survive and be at least marginally profitable, assuming no live events. And so we're going into the new year with the same platform. Assume there are no live events through the end of the year. I'm hoping that second half we will, next fall we will. So we're planning some hybrids, but they all have a backstop online only option for everything we're planning for 2021. And so we have those the target, and we have, but we have a conservative, and there's a bonus pool for the conservative target, and there's a much bigger one that's exponentially bigger if we hit our target. So that's how we're kind of approaching it this year. We're kind of, which is new, but we actually like that. We like doing that way. It lets me sleep better at night, knowing that even if the negative guys of my team are right, we're still going to be, solvent and still be profitable.
I think that's a very powerful, that sense of budget, like budgeting the expenses so they can handle whatever the scenario is, as a way to, that's an incredible risk reduction strategy.
That's right. Yes, and then and we are making investments. We're hiring a few key people, but we're doing that, with the conservative assumptions. Can that still bring a return by hiring that executive or that tech person? Well, do we still have revenue conservative scenarios to make it work?
Yeah. Before I switch over to Cindy on that question, when you look, let's say you're conceiving of adding 2 new senior level positions, is that are you thinking fourth quarter 20, or are you looking out a little further on that at this point? What do you think the timing would be?
Well, in fact, I'm giving this presentation to our CEO Talent Summit tomorrow on, there was a famous CEO years ago who talked about it's kind of like great CEOs are kind of like racing car drivers that they learn that you're better off hitting the brakes before you get into the turn so that you can accelerate through the turn. And so I've been very slow on hitting the brakes in the last recession, in prior recessions, and burned through a lot of money. So this time we kind of used our own medicine, and we trimmed anybody who was not an A player or at least a B+ player. We trimmed about 12% of our staff. We did a furlough, and then it became permanent. We went to all our managers, and said, is there anybody you need on the team, or you really want on the team? When we get when the sun comes out, we're going to keep. But anybody who is marginal or a gentleman's C, this is the time. So we did that and got our cost structure, in a better place. We're still losing money, but not as much. And but now we're profitable again. So we're being pretty aggressive now. We feel like this is a year ago, everybody was talking about the talent shortage, and that was the biggest constraint to growth. So we're feeling like if we can be a little faster than others, we can bring in some great talent. And so we brought in one great publisher who just joined us 2 weeks ago, September, beginning of September. We have another senior hire that's starting up next month. And we have another one that we're recruiting that we're hoping to bring in by the end of this year too. So
earlier on the cycle, so it'll have more impact.
We're not seeing recovery, but we're seeing at least things have stabilized enough that we think that we can justify those with our plans for next year. Yeah.
Cindy, what's your sense in this area? What are you changing in your planning process? As Wayne talked about, how are you looking at it differently?
Well, this year, obviously, when we all went remote, we forecast our events business down significantly, and we've been really pleasantly surprised. We've exceeded our original budget revenue targets on most of our virtual meetings, and we actually didn't see that coming. We've been very happy to have that happen. And where we've seen that, and I think Robin might have asked a question about, are you seeing more people from the rest of the world come to our meetings? And that's absolutely been part of it. We're seeing a lot more people from Australia, and we obviously are doing things live, but they're accessed, whenever. So we're seeing more of that revenue come to us from the global perspective. And the other thing we did was have our sales team go out and sort of aggressively offer really good discounts to the people who'd already registered and say, look, bring your team. Let's bring in more people. This is a great opportunity to train more folks. And we just saw our numbers exceed our original budget. But I'm going to be pretty cautious, I think, for at least the first half of next year. And we're probably going to keep it kind of level, sort of do what Wayne is saying, have something that is, I think, going to be achievable. And as we go up, have that, some incentives for going over, which is what we saw this time. And I do think that we're going to be totally virtual for the first half of the year. And I think our plan is to move to more hybrid events in the fall. I do believe that we will have a vaccine that will be widely distributed, by the middle of next year. There's a zillion questions. This is all I think about, like 24 hours a day right now is the COVID vaccines and treatments. It's kind of all we talk about. But I do think that we will have something that will be helpful, but it's not going to get us back, I don't think, to everybody traveling and the same levels we've seen. One thing that we've been doing also with our events now is actually putting, and I suspect most of you are doing this, but we've seen this be attractive to people. We're putting we're doing a lot of pre-recording, and we're putting pre-recordings out about 3 weeks prior to sort of the live event. And so people, we're shipping like physical books to people that we're asking them to read and get prepared. We're doing some digital too, but we happen to have some speakers who have physical books that we've bought, and we're shipping them out to people with other little goodies, that we're putting in there for the meeting. We're trying to do some physical, like, swag mailings for most of these to help kind of create some engagement and help people feel, comfortable in what they're doing. But that's really been helpful, so that much of our time spent on the virtual events is in conversation and discussion. And we've seen a lot of sort of stickiness around that. And the people who've come to our events and registered for the events are actually showing up and staying with us, through these conversations. So it's something that we're using to figure out what our budgeting is going to look like for next year, sort of a renewal thought, basically.
Well, I would suggest everyone to come to the events roundtable that's coming up, I think next week or maybe a little off on the calendar, because I like the nuances of what everybody's doing, and creativity around the events is really working. And in answer to the sort of the question of do I think I can replace my revenues for next year? My answer to that is sort of, I've got a big bet coming up in March on a new data product that the conservative budget for that replaces the loss of event revenue and would put us in a top line growth mode, or, in the, let's say 8% range, which would, if we hit that, I'll be ecstatic. I know many of the people on the call are sitting in the weird situation that because they've gotten out of their hotel contracts, they're smaller but way more profitable than they were last year. In our case, we also got the PPP loan on top of that, which is going to show as profits after it's forgiven, taxable profits no less, I guess. So we're in the very weird situation that we're cash richer than I've ever been in my business career. We're a little bit smaller, and we're in pretty good position for growth next year. As Wayne said, I'd like to not repeat the same mistakes I've made in the past and do that same thing. So thank you for reminding me of that. So I'll sort of end and then maybe open it up, because we're at the end of 45 minutes, but I'll end with Dan. Given what everybody said, we pivoted, we've adjusted, we're adding new content, we're adding new product diversification, we're adding increased segmentation. A lot of people have mentioned that. Top and bottom line, where are you hoping to end up, Dan? I'll dump that question on you first. And I realize you've got some big players over your shoulder, so maybe you're getting told what you have to come up with. So what are you hoping for?
I'm happy to share what I'm hoping for. I will sort of caveat this by saying, everybody's business is different. And so what I'm experiencing may not be what others are experiencing. But, we're seeing largely what's going on in society. We have a digital subscription business. Digital subscriptions are thriving. That's 80% of our business. Societally, more people are recognizing the need to pay for high quality content, and people are becoming more accustomed to subscribing to services, subscribing to content. Everything from, the Financial Times, my parent company, and the Wall Street Journal, the New York Times, to Netflix and Hulu. People are just becoming more, and Harry's Razors. I mean, people are becoming more accustomed to subscribing to things. So that general trend is wind in the sails of my core business. On the event side, we followed the sort of advice that came out of the community, of the publishing community. We said, look, we can provide great content. We can do it virtually. We're probably gonna have to charge less to attend, but we're gonna go for scale and try and bring more people in. We did that. Our top line on our events this year was lower, but profits were higher. So, top line's down maybe 20%, but there's more profit. There's probably 15% more profit without paying for any hotels or AV or any of the things that were listed in today's call. So, for next year, to cut to the chase, for next year, we are forecasting revenue growth year over year and profit growth year over year. But, that's being driven more by the digital subscription business, whereas the events business I'm being much more cautious on, and the advertising business I'm being much more cautious on.
Thank you. Cindy, can you take that one? What are your guesses or hopes or dreams or fears as far as targets for 2021? Oops, and you're on mute.
We're going to take a more conservative approach, I think, for at least the first half of the year, but probably up our revenue targets for events higher than we had taken them down for this year, because we've seen this kind of come up. I'm a little worried that people may get, sort of zoomed out and get tired of sort of the virtual participation. So I'm a little worried about how that's going to go. And I think that's something that we're all going to have to work on, keeping things interesting and fresh and different as we go forward, so people don't get tired of the way we're presenting information.
Yeah.
Our ad business was a mixed bag this year. Some went up, parts of it went down, partly because a lot of our advertisers are clinical trial sites and many of them shut down. And so we really lost that chunk of revenue. But on, say, the regulatory and quality side, on the manufacturing side, manufacturing didn't stop. So that part of our business, we saw advertising actually go up. Our content's pretty flat, and that's what I'm expecting it to stay at. You know, I think that is going to be a flat for us going into next year.
Yeah. I might mention that, like, a theme that came out of several of the comments, including from Elizabeth and Jen, you know, the models that we used to sort of discard, you know, either because they were too small or they weren't profitable enough. In this new model we're doing, you know, you can have a virtual event with a very small number of people that's profitable. You just have to be able to do it at scale, like Dan said. And so I would say that presents an interesting information to get into our secondary markets. You know, things that would have been failures last year, we've discovered new models where those could be successes. So, and I definitely, in terms of what we're thinking about doing, there's, you know, taking the virtual versions of what we were doing and going into some of the niches between our market and the secondary markets that our customers serve. So, and then as I said, you know, I'm thinking of discussions I've had with other people, including many who are on this call, you know, having the, you know, the ability to, we've managed costs, we've taken the hit there. So we're going to manage that very carefully, you know, so now any little success we have is incremental to the bottom line. And again, we have the irony at BVR that this is going to be the most profitable year, you know, we've had and we're down from, you know, in our case, 7.5 million to about 6.8 or something like that. So we lost ground, but at the bottom, it's weirdly, it's all gone to the bottom line. I don't know how that math works. So I look forward to next year being able to fill that revenue gap again, grow off the top of that by expanding these new, speedier, more nimble products we all have, and then taking a conservative financial swing for the fences with this new data product. You know, in the low cost environment, you can launch things so that if they fail, they won't take you out, which wasn't always the case. So I don't know. So some optimism there, though I'd summarize everyone's comments that if we can get back to steady state, keep the costs low, improve the bottom line, that's going to be a good year for 2021, which is a message that I hope gives everyone some hope and optimism. If, you know, if you're not sitting looking at your spreadsheets and saying, wow, where do I get 20% in 2021? You know, that, which is something we used to think about in years gone by. We're over the time limit. I know at least Wayne maybe has another obligation, but if you don't mind, if, you know, just anybody have a particular observation or question, and then we'll, even though we're going a little bit long, we'll try to close out. Based on what you heard, raise your hands or chat or.
There was a few questions in the chat.
Yeah.
And I'll maybe do this one first since Wayne is going to hop off in a second.
Yeah.
Tom asked if you had any concerns or issues around cannibalization from the segment extensions that you're doing. That question was for Wayne.
Okay. Yeah, there is some cannibalization, but we feel, you know, net we look at how much will we lose in the core product versus how much we'll get from the new segment, and net will net it out. So when we launch like our manufacturing CEO newsletter, we did take away some advertisers from our general CEO briefing newsletter, but there was enough people who wanted to reach that specific segment that we felt that we'd be better off and more than cover the additional cost. So we're looking at that across each of our products. But in general, we feel that the more segmented, the more niche, the more defensible it is, and higher value, it's a better fit in terms of content with what that specific person needs. So net, we tend to feel it's worth the trade-off.
Sure. Could I also notice there's some questions on the, Dan, Cindy, Elizabeth, or Jen, anyone can answer here, but what are you hearing from the parent organizations or the investor organizations? Like, is anybody is anybody hearing 20%, the old Thompson mantra from years gone by?
We're private equity owned. I saw a question pop up about that.
Yeah.
And so far, they've been extremely realistic and in fact kind of thrilled that we're doing as well as we are. I think, as a senior team at WCG, even beyond my group, we were pretty brutal about forecasting down for this year, and we have come through it collectively kind of amazingly well, and we're actually very likely to hit our original revenue targets. That we set. We're already significantly ahead of last year, and I think that we may end up. So I think for next year, our investors are kind of saying, what, just kind of repeat what you did this year. You guys were great. And so we're not seeing a lot of push to do anything extraordinary, kind of steady as she goes, keep trying to do what you're doing. And so it's been great for us. To be able to do that.
Jen, Dan, what are you guys hearing from from up above?
Yeah, same. I mean, we're definitely being conservative. We have bank covenants to hit as well. I mean, I'm guessing next year it'll be higher on the virtuals we did this year. Probably a little more aggressive on our media or digital, because that's doing okay. But not budgeting for live events to come back, in any way, shape, or form, at least until the back half of the year, and even then, maybe only 50%. So.
Gotcha. Dan?
So, from my perspective, the FT is not a private equity entity, so it's a little bit different. But I certainly get guidance and requests from up above. I think the thing I'm most concerned about, and this would be, not unique to the FT, but most of the investments that you make are represented as costs in your P&L, but they don't pay off in the same year. They pay off in the following year. So I can deliver growth next year based on prior investments. But if the costs if there's too much pressure on costs, that lasts per year. But then the following year, hey, and because of the disconnect on timing, because they're because they're a P&L apart, it's sort of easy to say, hey, we'll take this year's growth, but let's not make this year's investment.
Yes.
We'll worry about that down the line. And that's where I have to make sure I'm making the case on, the need to continue investing through a crisis like this.
Yeah.
And to show that the performance we've had has been very good, and they don't want to lose that. But I also say, credit to the FT, that they're a great owner, and it's a good relationship. So I'm confident they'll hear that. But I know the tendency is to say, let's roll down those costs and take in the growth.
Yeah.
Yeah, Dan, I feel your pain acutely. It feels like even in non-pandemic, non-recession times, that's always the cycle. If you don't see the return on an investment in year one, it's like, well, and then you get into the cycle of not being able to, innovation becomes a much shorter cycle than it should be.
Yeah, there's the, you want to Dan's point, you want the timing between keeping the investment going and when the first dollars comes in to be even closer than it's ever been before. It's like, okay, I hired you on a Tuesday, or I invested in this new technology on a Wednesday. Can we get some sales on Monday. How's that working for you? You know, so you're shortening that time frame again and again. So, okay, well, I think I'll go back to what I said at the beginning. Everyone on this call is on, the channel. So please keep the discussion going about, what your budgeting targets are, what your experiences are. I'm coming away from this with a very strong sense that we all deserve a pat on the back for moving as quickly as we have. We're all still standing. That's worthy. And none of us can go crazy next year, but we're not stopping. We're all moving ahead. And if the result of that is sort of break even at the top or flat at the top and increasing at the bottom, that's a worthy goal in an unstable economy. And if we get lucky, maybe we'll do a little bit better, as Cindy said. Last couple of things. Please keep active in the channel. I think Stephanie's going to float a poll, if you could keep giving any feedback through the channel about what you want to hear about, and sharing your community thoughts, that'll continue to make it a great place to learn from. So thanks to all of you. Lots of love. Take care.